So now we have looked at how to calculate the tax base when it comes to an asset, and you've seen how the temporary differences work regarding the carrying amount less the tax base when we're dealing with an asset. But now let's focus quickly on the tax base of a liability before we move on. So let's have a look at an example. Here we have company A who had the following liabilities at year end. They have trade and other payables of 150,000, a lease liability, which according to the Tax Act is an installment sale agreement of 200,000, a lease liability, which again for tax purposes is a financing agreement of 13,000, and then we have revenue received in advance of 20,000. The year end is 28 February 2020. So let's have a look at the difference quickly between an installment sale agreement and a financing agreement. An installment sale agreement is where ownership of the asset has been transferred, and the lessee, in this case the company A, may claim a wear and tear allowance on the asset, and they may deduct all interest that's been incurred on the lease liability. An example of this would be where a company does not have enough money to buy, let's say, a new motor vehicle cash, and so they obtain financing to help them pay for this asset or this motor car. And once this motor car is completely paid off, full ownership is transferred to this company, but they have entered into agreement where they're actually buying this motor vehicle. A financing arrangement, on the other hand, is where ownership of the asset is not transferred and the lessee may claim the full installment on the liability as a deduction. So, in other words, that would be the capital and the interest that's been incurred on this liability. The lessee may not claim any wear and tear allowance because, according to SARS, they do not own any asset. Okay, they are merely just renting an asset for a specific period of time. So, an example of this would be where, let's say, for example, company A is going to rent a new premises from which they're going to run their business from, but they have no intention of actually buying this business. They are merely just using this property to run their business from, and they've signed a certain lease term for which they may use it, which they could sign again in future once this lease term comes to an end. So they're not going to become the owners, they are merely just paying the owners every month so that they may use this property. There is a little bit more into the classifying between an installment sale agreement and a financing agreement for tax purposes. The VAT Act has made it quite clear when an asset will fall into an installment sale agreement and when it will be a financing agreement, but that is just in short to give you a little bit of background. And we're not going to go much further into that as long as you know what the difference is between the two and how they are treated differently for tax. You will be told in a question whether or not you are dealing with an installment sale agreement or a financing agreement. So if we have a look at our calculations, or we start our solution now, we start off with our carrying amount according to our accounting statement of profit or loss. And these will be the carrying amounts based on the applicable accounting standard, your IFRS standards. So here we have our trade and other payables. And now to calculate the tax base, which is according to our tax statement of financial position, we need to take the carrying amount, which is 150,000, and deduct all amounts deductible in future. Now, when it comes to trade and other payables, no amounts will be deductible in future because all expenses that are related to those trade and other payables would have already been claimed in the year that they were incurred. So if there's a balance for trade and other payables, it has already been deducted for tax purposes unless you are specifically informed otherwise in the question. The temporary difference is the carrying amount less the tax base, and as these two amounts are the same, your temporary difference will be zero. When it comes to the lease liability, which is an installment sale agreement, for accounting purposes, the carrying amount is 235,000. For tax purposes, we need to use the carrying amount of 235,000 less amounts deductible in future. But we've said that it's an installment sale agreement, and we know that when dealing with an installment sale agreement, we are not allowed to deduct the capital portion of a lease liability. We're only allowed to claim interest. So therefore, the amount that will be deductible in future will be zero because this lease liability of 235,000 Rand is only capital. So nothing is deductible in future. So our carrying amount is equal to our tax base. The temporary difference will therefore be zero. When it comes to the lease liability of the financing agreement, for accounting purposes, our carrying amount is 13,000, but for tax purposes, our tax base will be the carrying amount of 13,000. But now we are dealing with a financing agreement, which means we are allowed to claim all capital and all interest on this liability. So that means that that full 13,000 Rand is deductible in future. So we're going to have 13,000 Rand being the carrying amount less 13,000 Rand deductible in future, which gives us a tax base of zero. So our temporary difference is then going to be 13,000 Rand. So when we're dealing with revenue received in advance, we have 20,000 Rand. And our tax base for revenue received in advance, we start off with a carrying amount of 20,000, and then we need to deduct amounts not taxable in future. No portion of this would be taxable in future because it's already been taxed now. So therefore, we're going to have 20,000 being the carrying amount, less 20,000 because we're not going to be taxed on that in future. We've already been taxed now when that was paid. Because when you're dealing with revenue, you are taxed at the earlier of accrual or receipt. And that gives us a temporary difference of 20,000 being the carrying amount less the tax base.